All right. So I would say let's start. And before we go on, before we continue with the new stuff, we do a short repetition, and you can tell me what you remember. I will ask you questions from time to time. You can tell me what you remember from last section. So I'm very happy if you contribute to this lecture and tell me. So, and it is better for you too, because then you learn more actually. Last time we talked about the differences between financial accounting and managerial accounting, and we said that financial accounting, and this is mainly what we do here in this course, is addressed at external decision makers. So we said external decision makers are investors. Can anybody of you tell me what an investor is? What is meant by an investor, and what is the goal of an investor in a company? Okay, Ray says it's shareholders. This is correct. Ray actually writes it in the chat. Shareholders is correct. So they own a piece or several pieces of shares in the companies, and their goal is that the company is profitable, and the value of the shares increases over time. Then another external decision maker is creditors. What is a creditor, for example? Any idea? Okay, yeah, it says it's a bank. It's very good. Yeah, a bank. A bank is a creditor, and Ray says bondholders, which is also correct. Bondholders can be private bondholders, or it can also be institutional bondholders. All creditors, they lend money to the company. Yeah, the company is the borrower, the creditor is the lender, and the company has to pay interest to the lender, and at the end of the maturity, the company has to pay it back. Then there is regulators. Yeah, regulators is, for example, the regulatory bodies that sets the rules. Yeah, in Germany, for example, we have the BaFin. Yeah, that's the regulator that controls the banks and other companies. Then we have suppliers. Suppliers. Can you tell me what a supplier is? Maybe write it in your own words. What does a supplier? Provide services, says Ray, and goods to the company, and the company resembles them. Provide goods and materials, yeah, and the company then manufactures, produces something and resells it. Yeah. By the way, Ray asked about whether the government can be, I think, a regulator, and this is correct. Yeah, the government can also be regulator. but doesn't have to be the government, but can be the government. Government. That's correct. So regulator. The public and customers. I think I don't have to explain what a customer is. So this is the parties that financial accounting is addressed at. And what is the document? The most important document is it's the annual report, and the annual report has several constituents, and they are shown here. So it's some corporate information, then analysis and commentaries. We have a letter from the chairman and a letter from the CEO. Do you remember what the difference is between the chairman and the CEO? No, the CEO is the boss of the management, boss of the management. This means management, and the chairman. The chairman is the boss of the board. This is boss of the board, and the board controls the management of the company. This is the boss of the board. And yeah, then we have other statement and disclosures. But the most important part of the annual report is the financial statements. And do you remember what the financial statement? Do you remember any financial statement from last lecture? The balance sheet, yeah, the balance sheet is correct, says Liang. We have the balance sheet. We have the cash flow statement, also correct. We have the income statement, yeah, and then we have the statement of changes in shareholders' equity. Yeah, so these are the four financial statements. Yeah, very good. We have the external auditors, and they give their opinions about the statements. Yeah, and the external auditors, they say whether the statements are completely correct, Yeah, Ray added that there are also the notes to the financial statement. This is correct. Yeah, there are the notes to the financial statements, and the notes to the financial statements, they explain what is in the financial statements. Yeah, they are. That's why they are explanatory notes. Yeah, but now we are at the task of the auditors. And the auditors, they are there to give an opinion about the statement. And there are 3 different opinions, as you remember. So there is an unqualified opinion, which basically means everything about the financial statement is good. Unqualified opinion, yeah, which is very good. Yeah. Then we have a qualified opinion. Yeah, there's qualified. Opinion, which means there is a disagreement in one section of the annual statement. Yeah, it means basically they are correct, but there is a disagreement in one section. Yeah, maybe in inventory, the auditor says, okay, there is something not completely correct. And then we have the third. This is called an adverse opinion. And the adverse opinion, this is bad, yeah, because adverse opinion is the opposite of an unqualified opinion. And it means that the statements do not fairly represent the company's financial position. Yeah, it's an adverse opinion. Yeah. So unqualified opinion, this is good. Yeah. An adverse opinion is bad. And the qualified opinion is somewhat in between. Yeah. And the financial statement of all listed firms have to be audited. Yeah. We have business transactions, and the business transactions have to be recorded in an accounting systems, and they produce the financial statements. Yeah, the business transactions. We will talk about the business transactions today. This will be the major topic of today's section. Yeah, so here are the different financial statements. We said that accounting is the language of business, and double entry accounting is the basis for financial reporting. Do you remember why it says double entry accounting? Why does it mean double entry accounting? Double entry means two it is always two accounts affected. Yeah, two accounts affected, or let's say at least two accounts. Yeah, they can also be for one transaction. There can also be more than two accounts, but at least there are two accounts affected. Yeah, let's make an example. A firm buys a machine. Yeah, there are two accounts affected: the machine, which is an asset, and cash. Yeah, because the firm has to pay cash. So two accounts affected: machine and cash. That's why it's called double entry accounting. And here when you remember, you see that we are actually what we are talking about is basically IFRS. And IFRS can you remember what IFRS stands for? What is IFRS? IFRS is International Financial Reporting Standards. Yeah, and so they should be accepted in many countries, and that's why they are called International Financial Reporting Standards. Yeah, so they are the international rules, and you see here in blue most of the countries actually have accepted them. An exception is the United States, for example. They have not accepted international financial reporting standards. Their standards are in the United States it's called US GAAP. Yeah, but most of the countries, for example, Germany or China or Russia, Canada, they have in some form accepted the IFRS. Yeah, in the United States we have the US GAAP. This is different to IFRS, but not much different. Yeah, it's very similar, and that is why when you learn IFRS here, you can also understand the financial statements of companies which are listed in the United States. Yeah, you can understand the statement of, let's say, Apple or Google, because they are so different, so similar, sorry, than IFRS. Yeah, we have international. These are the reasons. We don't have to repeat them. Active. You can read it at home. Don't have to repeat everything. Have several assumptions. This is important, and we will talk about that. The elements of financial statements are assets, for example, and assets are economic resources. Can anybody of you give me an example for an asset? What is an example for an asset? Yeah, exactly. Cash, for example, cash is current assets, cash and cash equivalents. Exactly. These are all assets. This is what the company owns. Yeah. Then we have liabilities, which is obligation, which is what the company owes to another party. Can you also give me examples for an obligation from the perspective of the company? Cash, for example. Yeah, accounts payable is an example for an obligation. Yeah, bonds would be another. Yeah, accounts payable. And we have equity. Equity is the residual interest in assets when deducting liabilities. Yeah, we have the accounting equation, and the accounting equation basically says that assets equals equity plus liabilities. Yeah, so this is the accounting equation. This is an E. Yeah. As assets equal equity plus liabilities, and you can transform it, of course. And when you have formed it, you see that equity equals assets minus liabilities. Yeah, and this is what stands here. Residual interest in assets when deducting liability. This is equity. Then we have income, and income increases rather in equity, which does not come from shareholders. Yeah. For example, when you issue new shares, this is an income that comes from shareholders. Yeah. But here we're talking about increases in equity, which does not come from share owners. So, for example, revenue. Yeah. For example, say revenue, sales revenue. Yeah, this is part of income. Revenues is income that comes from the core business. Yeah, for example, when BMW is selling its cars, then that is revenues. Yeah, and then we have expenses, and expenses are decreases in equity not going to shareholders. Yeah, decreases. Yeah. Ray says there is also other income which is not related to the core business, and this is, for example, finance income. Yeah, when the company, for example, receives dividends, yeah, because it has an interest in another company, then this is finance income, and this is also part of income. Correct. Yeah, and expenses, cost of sales, R&D expenses, these are all decreases in equity, not going to shareholders. Yeah. Can you? So let me write that down. So, for example, costs costs. I will abbreviate that. Costs of goods sold. Yeah, cost of goods sold, for example. Yeah. Can you also give me an example? What is a decrease in equity that is going to share owners? Yeah, this is not an expense because expenses are not going to share owners. But what is a decrease in equity which is going to share owners? This would be dividends. Yeah, dividends are payments to share owners, and they also decrease equity, but they are not expenses. Yeah, because expenses are defined as decrease in equity, not going to share owners. Yeah, we see the income statement. This is the same. Statement of profit and loss. Our income statement is the same. Yeah, and you have on the left hand side you have expenses, all the expenses. On the right hand side you have sales and revenues and other income items. Yeah, other operating income, finance income. Yeah, and yet when you subtract the expenses from sales revenue, you get net income, net profit. This is basically whether a company has a high net income or high net profit shows the performance of the company. Yeah, whether the company has a good year or a bad year. And it is always is important to remember that this is always, the income statement is always for a period. Yeah, the income statement is for a period, and this is mostly a calendar year. Yeah, this is mostly a calendar year. Is not a snapshot. Yeah, a balance sheet, for example, is at a point in time. But the income statement is for a period. Yeah. What generates the revenue? If you provide goods or service to customers, BMW is selling its cars, Amazon is delivering its goods or services. Yeah, it is not necessarily when cash is coming. Yeah, so it might be that that cash is coming later. Yeah, but cash and revenue is not necessarily at the same time. Yeah, this is called accrual accounting. Accrual accounting means that there can be a difference between revenue and cash. Yeah, and between expenses and cash. So revenues cause equity to increase and expenses cause equity to decrease. Net income or net profit is also called the bottom line. Yeah, why is it called the bottom line? Because it is the bottom line of the income statement. Yeah. Yeah, this is the income statement in a little more detail. Yeah, we talked about that there are other income elements than revenue. Revenue is the core business. We also have finance income. We also have finance income, which is dividends received, for example. When a company receives dividend, other income can be non-operating income. For example, when the company is selling a machine, yeah, let's say the company is selling a machine and makes a gain, yeah, this is other income. We have the expenses. We have several expenses, actually. We have here the cost of sales or cost of goods sold, which is the same. Do you have an idea what cost of sales or cost of goods sold, what it means? Can you give me an example? Or can you explain me what it means, cost of sales? Any idea? That's the cost that is directly related to the products. Costs directly related to the product. For example, if you sell a table, yeah, let's say you sell a table and the wood is directly related to the product. It's not the salary of the CEO. Yeah, the salary of the CEO does not belong to cost of sales because it's not directly related to the products. Then we have R&D expenses. R&D expenses, I think I don't have to explain it. Do you have an idea which industries have high R&D expenses? Yeah, Sue says IT. This is correct. IT or pharmaceuticals, these industries have typically high R&D expenses, but also others, of course. And we have selling, general, and administrative expenses. This is the salary of the CEO. Yeah, this is also called overhead costs. Yeah, because it is not directly related to the product. We have the finance costs. Finance costs is basically, this is interest expense. Yeah, so when a company pays interest. Interest expense, this is finance costs. And then we have the tax. Yeah, all the companies, at least when they are profitable, have to pay taxes, and this is also an expense. And if you deduct all these expenses, you have the net income. Yeah. Okay. This is the balance sheet, and one major difference between the balance sheet and the income statement is that the balance sheet is at a point in time. Yeah, and it is not for a period. It's not for 1 year actually, but it is it is at a point in time, and this is usually the end of the year. So this December of 31st. Yeah, but it can also be at the end of a quarter or something like that. Yeah. So what do we see on the balance sheet? We see the assets and we see the liability. Assets is what the company owns. Liabilities is what the company owes. And we differentiate between current and non-current assets. And current assets are expected to be recovered or settled during 12 months. So 12 months is current assets is less than 12 months. Non-current assets is more than 12 months. Yeah, more than 12 months. And you can also, that's why you can also call non-current assets long-term. This is long-term assets. And the same goes for liabilities. We also have non-current liabilities, which is more than 12 months, and current liabilities, which is less than 12 months. Yeah. Another difference between current and non-current is basically that current is within the operating cycle. Yeah, operating cycle means you buy something to sell something. Yeah, BMW, for example, they are buying tires, they are manufacturing the tires, they are producing the cars, and then they are selling the cars. The BMW has an account receivable, and then finally the customer is paying for the car, and the BMW has cash. Yeah, and with that cash, the BMW is buying tires again. So this is the operating cycle of BMW. They're manufacturing everything they need, everything they manufacture, reassemble to sell their cars, basically. Yeah, non-current assets is different. Yeah, a machine, for example, is typically not sold in the case of BMW. BMW doesn't sell its machinery, and it also doesn't sell its let's say its buildings. Yeah, BMW uses the machine to produce something, but this is not called the operating cycle. We can also go through the subcategories of assets. We have current assets. Elements of current assets are cash and cash equivalents. I don't have to explain cash because you know what cash is, but cash equivalents is a short-term financial instruments, which is very safe and basically which is very similar to cash, and that's why it's called cash equivalent. You can basically, you can say, if I own this safe financial instrument that I can turn into cash every single day, then this is basically pretty much the same as cash, and that's why it is called cash equivalent. Then we have accounts receivable. When BMW is selling, after BMW have sold its cars, but the customer has not yet paid, the company has an account receivable. Account receivable is outstanding before the customer pays. Then we have inventories. Can you give me an example of inventories? Let's say in the case of a car company, in the case of BMW. Any idea? What is inventories? Yeah, the chicken wings in McDonald's. The car is correct. Yeah, when the car is finished, it's finished product. Let's say it stands on the backyard at BMW, then this is inventory. But also the tires, for example, the tires and everything, let's say the raw materials. It can be finished products, it can be unfinished product, it can be raw materials. This is all known as inventories. And then we have other current assets, which is for example, prepaid expenses. Think about you say one example is prepaid rent. Prepaid rent. A company that means a company pays its rent in advance. A company pays its rent in advance, and then it pays its rent in advance, and basically it means that it has an asset. When the rent is paid in advance, the company has an asset. Why? What is the asset? The asset is the company has the right to use the building, or the office. That's why prepaid rent is considered an asset. We have non-current assets. Non-current assets is financial investments. That can be stocks. For example, and also bonds. Stocks, bonds. We have property, plant, and equipment, and we have intangible assets. Options, exactly. Options can also be financial investments. What can be an intangible asset? What is an example for an intangible asset? Goodwill, yeah, goodwill, correct, or trademarks, yeah, trademarks, patents. On the other hand of the balance side of the balance sheet, we have accounts payable, we have notes payable. Do you know what the difference is between accounts payable and notes payable? Any idea? In accounts payable, first of all, the company buys, let's say, raw materials, but the company has not yet paid. So unless it has paid, it has an account payable. Note payable is very similar, yeah, but the note payable is more formal, yeah. So this is more formal. It also carries an interest on it, yeah, and it's more like a bank loan, yeah. This is, you can say that it's more like a bank loan. It's more formal. We have accrued expenses. For example, taxes payable, salary payable. This is when the company has expenses but has not yet paid for them. Yeah, salaries payable. Maybe the workers have already worked for the companies, but the company has not yet paid for those workers. Other current liabilities, and we have unearned revenue. Unearned revenue sounds a little bit strange because basically it's called revenue, but nevertheless it's a liability. A unearned revenue means that basically it means that the company has already collected the cash but has not earned the revenue. Yeah, think about a concert. You have paid for the concert. You as a customer, the company has received the money, but the concert has not yet taken place. Yeah, the company, of course, has the money, but it has to book a liability which is called unearned revenue, and not until the concert takes place, the liability has to be still on the balance sheet. Yeah. Then we have non-current assets, which is, for example, provisions. Provisions is liability that are probable, but they are not sure. Yeah, it's not certain that this is a liability, but it's likely. It's more than 50% likelihood. We have deferred tax. We have deferred tax liabilities, and this is basically when you know that you have to pay taxes, but you do not have to pay them yet. Yeah. For example, think about when you have a stock. The stock appreciates in value, or rather it has appreciated in value, and there is a tax on the gain on the stock, but you have not sold the stock. Yeah, then you have to book a tax liability, and the size of the tax liability is basically the percentage of the capital gains tax, and that is shown on the liability side of a balance sheet because it is a liability. It has not yet been paid. Then we have loans. Loans is usually from banks. Yeah, this is mostly from banks. And we have bonds, and bonds are actually small pieces of securities. Yeah, similar sorry, that was a mistake. This loans is from not from bonds, but banks. Yeah, so this is banks, from banks, and bonds are small pieces of securities that can be sold any given day on an exchange. Yeah, very similar to a stock. Yeah, and then we have other non-current liabilities. Okay, I would say let's make a break here. Break, 10 minutes break. 10 minutes, and then we continue. Okay, see you soon.